Hey traders, this is Blake Morrow with Trader Summit, and it's Friday. I've got Mr. Jim Welsh of Macro Tides with us today. And Jim, what an explosive move in the stock market, as you have been anticipating.
Yeah, the whole game plan here was that we all know from a technical standpoint, 4,200 was big time resistance. So that once you got above 4,200, you'd hit some stops. Technicians would say, hey, that's a breakout. They would turn bullish. And then, of course, the news that inspired it was the labor report, the jobs report last Friday that, was decent. So the fundamentalists are happy too, because it means we don't have to worry about a recession. So you have everything kind of coming together, and it's time to, have a jubilee.
It's funny. I was talking to a young economist. He runs a macro firm this week. I was just chatting with him, and nothing really. We were just talking, and I think we both agree that nothing changes sentiment more than price. So,
Well, and you knew news. I mean, for a lot of people, for them to understand price movement, it has more weight if there's an economic report or statistic that they can point to. Oh, that's why that's happening. That's a good thing or bad thing. In this case, it was a good thing. It just makes it easier for people to turn bullish. And from the technical guys, it's like, wow, that's a breakout. Oh, look at him, breath. One of the things that happened with the employment report is this idea that the stocks that had been suffering over the last 6 months and not performing as well, participating as well, all of a sudden caught bids. So we saw the Russell 2000 pop significantly, industrials, basic materials. If you look at a chart of the Russell, I try to limit how many charts we cover every Friday. I was thinking about putting in there, but from the October low, you can see when it broke down below, there was a breakdown in March.
I'm actually gonna grab that chart for you, Jim, right now. I'll pull it up for you just so everybody has a nice little visual of what you're discussing. Just give me 1 second.
So as we all know, everyone's talking about, oh my God, it's just the 7 stocks, the mega caps, everything else sucks, not doing well, blah, blah, blah. And now you had really only about 2 days where market breadth was pretty decent. And the Russell had a big move. And so if you, let's say from that low in October, connect it to the low in late December and bring it up. Well, our heads are going to cover it. But basically what you can see, if you take it up, there you go. We hit the underside of that low. That trend line. So you broke down, this is classic chart analysis, and then you go hit the underside and you run into some resistance. So to me, a lot of things have come together from a sentiment standpoint, technical standpoint. We've talked for quite a while about the 618 retracement on the S&P being 4311. So for me, a lot of things have kind of come together to suggest that we're at some kind of a high. The depth of the correction will be determined and dictated by, does the economy show more signs of slowing? And I think it will, because again, this whole rally has been predicated on, gee, we're not going to have a recession. The job report confirmed it from a lot of people's minds. Earnings are going to be up 11% by the end of the year, and the Fed's going to hit the pause button. How can you not be bullish? So, but now's the time, I think, to be worried, because as I explained in the June macro tides, the indicators that have had the great track record of calling recessions, like the inverted yield curve, inverted in July. Most people don't know the average lead time is 19 months on that, which is one of the reasons why, I don't favor it or weight it as heavily. That's a long lead time. 19 months last July gets us late this year. The leading economic indicators down 13 months in a row. That turned negative in November. Lead time 10 months. Well, that gets us September. Lending standards going up. Lead time 6 to 9 months. That turned negative at the end of last year. So there's a lot of these long-term economic indicators suggesting we're heading into a bout of weakness as we get towards I've been saying after mid-year, they're kind of pointing to the late third quarter. And I just think that that's what's coming. And now that everyone is convinced with the labor report being so strong, and the job market is the last thing to go. So anyway, I think it's a perfect setup. for a pullback in the market. Next week's going to be a little crazy.
Next week is going to be crazy. I mean, we got not only the Fed, we got the ECB, we got Bank of Japan. We're going into the beginning of summer. A lot of people are going to want to shore up their positions as they come into this summertime period where they know they're going to be, on vacation, on holiday for weeks or months at a time. It's going to be a real, and I think a lot of people have actually booked their travel for the next week following, for a lot of good reasons. So let's talk about, the key next week is going to be the Fed. Now we do have the Fed, but I don't, you might agree or disagree. More importantly, less important, that we have CPI and PPI coming out just before the Fed meeting. Do you have any thoughts there? And I don't know if you brought charts regarding that.
I didn't. Again, it's kind of like trying to limit things, but in this coming weekly technical review, since it's coming out on Tuesday, I go through it. And the main point is people have to understand that it's a 12-month rate of change. So you take away the gain that happened in May of 2022, which happened to be a plus 0.97. So we're subtracting 0.97 from the other 11 months, and we add in whatever the inflation is for May of 2023. Well, last month it was up 0.4. I think there's a shot it'll only be up 0.3. Energy prices are down a little bit. The shelter component has started to soften. So the point being is you subtract 97 and you add 0.4, maybe only 0.3, which means you're going to subtract 0.5, 0.6. So I think there's a good shot. The headline CPI is going to go from 4.9 down to about 4.3. That's kind of a big drop.
That is.
The prior month, it only went down 1/10. The core is going to start to play a little catch up because the shelter stuff, which I explained in the June macro tides, is going to start to kick in. In other words, the takeaway values from last, it's a lagging methodology. And we've known that rents have been coming down, home prices coming down. Well, the calculation methodology is about to reflect some of that. So my point being is, I think when that CPI comes out, it may shape people's viewpoints in terms of, oh, the Fed is definitely not going to raise rates, and they may not even, with this information, have to go in July.
And they're going to be super dovish, and I bet you got something to say about that. So let's go into your first chart. And that leads us right into the first chart here.
Yeah, that's a great segue.
Tell us what we got.
You're pretty good at this, Blake.
Thanks. We've been working together now for a while.
It's been a while. So again, think about the internal debate that the Fed is going to have next Tuesday and Wednesday. You have people like Bullard, Mester, Kashkari are all in favor of hiking more. Then you have another group of people that, you know what, they went along with that hike to get up to 5.1 at the May meeting, but they would really like to wait and see. A week or so ago, Jefferson, who's a board governor nominated to be the vice chair, kind of supported the idea of a pause. Well, he didn't call it pause, a skip, So my point is, you're going to have this internal debate. And I think if they choose not to raise the funds rate, which I think is the more likely outcome, the hawks are going to want something in return. We don't want to give the impression that this is going to be a pause. We want to let them know that we still very well, and in all likelihood, will be raising the funds rate. So they produce their SEP, which are a bunch of projections. And my point is, you can see the PC inflation, they thought at the end of this year would be down to 3.3. I think they may tick that up a tiny little bit. The Fed funds rate at the bottom, you can see 5.1, which was what they said both December and March. I think, Blake, that's going to tick up to at least 5.2, maybe 5.3. In other words, the Fed wants to, I've heard a hawkish pause or whatever. I think they really want to make sure people are prepared or aware that inside the FOMC, there's a group of people that really think, okay, we're going to concede that we can wait a little longer to see how the data comes in. But they're going to be talking about the jobs number and wages. And the reality is, I think that's the compromise that they arrive at in terms of, okay, if we don't raise the funds rate, then we've got to do these other things to convince Wall Street that this isn't the end in terms of rate hiking cycle. And I think they're going to reflect that in the projections. And then after the meeting, they're going to have a bunch of people go out and give speeches. And I think what we're likely to see potentially, Blake, is the doves that want us to pause, or FOMC to pause, will go out and acknowledge that, hey, just because we didn't raise rates doesn't mean we won't down the road. So my point is, I think if they don't raise the funds rate, we're going to see the dot plots and rhetoric from even the doves opening the door to, hey, just because we hit a pause button, we just wanted to see more data. That doesn't mean we're done raising rates. And I think that's going to be the deflator, if you will, of the CPI comes in, raises expectations that, oh, the Fed can be done. And then they're going to, I think, dampen that.
All right. Well, the next chart, Jim, you bring in called hours worked. What did you bring this chart specifically?
Yeah. Well, the jobs report was plus 339,000, good number. Hours worked. If you think about what happens in the workplace, and we've talked about this, if you're an employer, you don't want to let somebody go, but what you do is cut hours. So what we see is hours have been cut for months, and now they're at a level that, going back the last 12 years, it's only gotten down to this level outside of a recession. So what's prompting employers to cut hours this much? And I have to believe that some of them are seeing that their business is slowing, or they're worried about it slowing, and they're paring back, but they don't want to let people go because it took them a long time to get employees, as we know.
Yeah.
So this, to me, takes away from the job number. This, in other words, this is a leading indicator of the labor market. The job number is a lagging indicator. This one is telling us that, okay, some softening is showing up. In addition, temporary workers, they've been letting them go, not aggressively, but that's a leading indicator in terms of the demand for labor beginning to wane. So, again, I've been saying the economy is going to slow in the second half of this year. One of the components has to be that, hey, by late this year, we're going to see the labor market reflect some of that slowing. This is a forerunner, I think, to that. And the next chart is, I think, more current, if you will, and that's the ISM services. And so to me, sometimes, Blake, it's interesting where one report gets a lot of attention and other reports sometimes get very little.
Yeah.
So what we can see is, forget about the huge spike we saw in 2021. All right, that we all know why that happened. But since January of this year, the ISM services has gone from 55.2, there you go, to 50.3. So it's a very, kind of decided slowdown. I don't think it's directly going to drop below 50. I think you'll probably get a bounce. S&P global number improves, so there's some distortion between these two reports. But my point is, the trend is I think, pretty clear cut. So for someone who's looking for more softening in the economy in the second half of this year, to me, this report is saying, you know what? We're starting to see some data points that are supportive of that.
Yeah.
We're not there yet, but it's supportive of that. And again, I don't hear anybody on CNBC. I have it running all day long. I like to hear the chatter, and now this week, hey, estimates for the S&P are being raised. Everyone's bullish, blah, 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 and yet this is flying in the face of that bullishness of people believing, oh, we don't have to worry about a recession.
It's interesting, Jim, because people want to hear what they want to hear, right? They want to reinforce what they're trading, what their beliefs are, price action that they see. And, services in contraction doesn't really fit my narrative being bullish, right? It really doesn't.
The other thing, too, is services are about 80% of GDP.
Yep. Mm-hmm.
Goods are less than 15. So what happened last year? Remember, you had 2 quarters in a row that were negative. ISM manufacturing number dropped below 50. Well, if you go back to the last 50 years, a drop in the goods below 50 was a decent predictor of a coming recession. But what people didn't factor in was that the demand for services was beginning to pick up as the economy reopened. They bought all the goods they needed when things were locked down. Yeah. And that demand was shifting into services, which was another reason why I explained last year, we're not going to have a recession last year. Now, all of a sudden, I think it's, to me, more and more data points are starting to suggest that the expectation for slowing in the second half, we're headed in that direction.
And remember, this is a good time for me to refresh the memory of traders right now. That a couple of different things. Jim, you know, a lot of people were calling for a recession at the end of last year, and you were distinctly saying, no, we got it. It's going to be 2023, and here's the reasons why. And I know what some people might, you know, call a technical recession. We're not. You could say it's technically a recession, but really all the data points suggest that it's not. And here we are, you know, fast forward 6 months later, or 6 to 8 months later, and now, you know, people are saying there's you know, maybe there's even no recession on the horizon, but you are pointing out that there may be one coming, and it's going to be interesting. So
yeah.
All right.
I mean, obviously, if things go as planned or expected, you know, it'll be kind of cool.
All right. Well, cool. I don't define cool. All right. So,
well, when you're in the business of trying to absorb enormous amounts of information, process it, and then come up with a conclusion and have it be right sometimes, that's pretty cool.
Yeah, you know? I guess it is cool. All right. So here we are.
Okay.
You know, the markets obviously don't believe your narrative. They think that the Fed is going to probably cut rates anyway when things slow down. So we might as well start buying stocks. Stock market's rallying. What's this chart of the S&P showing you? You've been calling for a move above, you know, 4,200 to 4,300 and change. Yeah. What's your target here?
Yeah. Well, first let's talk about what the bottom panel, which is the option premium, which is an indicator derived by premiums on calls and puts. And when it drops to a very low level, that's the green vertical bars, it's a sign of, I think, excessive optimism. And so if you go back the last 14, 15 months to January of last year, as the S&P was topping, then obviously the high in March, the high in April, it was a little early in terms of December, that high, but you know, ultimately we did pull back below it. And then February 2nd of this year, and not where we are now.
Now that's more extreme than we've seen it, right?
Yeah, it's a little, and it's hanging around at the low level. All right. So to me, sentiment, and if you look at the call put ratio, it's above where it was in February. It's back to where it was in August of last year. The Investors Intelligence Survey is about 30% more bulls. AAII, the American Association of Individual Investors, went from, I think, a net 7 bears, in other words, more bears than bulls, to, I think, a plus 14, back to where it was in November of 2021 in terms of the percentage of bulls. So the sentiment numbers, you know, again, once we got above 4,200, the expectation was you're going to see a lot of people turn bullish, and it's happened. And now these measures have hit extremes. So what happens as the markets top, sentiment gets to an extreme, and then you kind of have to wait for momentum to peter out on this move up that we've seen. I've been recommending people selling into the S&P above 4,250 and taking a partial short position at 4,250. Another one was taken at 4,310 this morning. The 618 retracement is 4,311. That trend line connecting the high from December and early February comes in about 43.40. So to me, there's the potential next week with the CPI coming in, maybe a positive surprise for some people, you know, get some more bullish about what they think the Fed might do. So the market may be able to extend a little bit to the upside. And again, what I'm waiting for is momentum to actually roll over. And the red trend line on the S&P chart is a 5-day moving average. The green is a 13. When the 5 crosses below the 13, you know, it's a trend following methodology.
Yeah.
You know, that'll be more confirmation that, hey, we've had it. If the Qs drop below 347 and close below 347, I think they were trading about 353 or so. This morning got up to 357. You know, that would be another sign. We've only had 2 days of good breath. We talked about the Russell 2000 got to the underside of the trend line, has backed away a little bit. So for me, a lot of things are coming together. The fundamentals, I think, are going to start to roll over and become more negative. Sentiment is very bullish, and we've hit price targets now on the Qs. The Russell hitting a trend line, and now the S&P doing the 618. it just may hold up here a little while. We're not going to see a big decline until institutional investors are given a reason to sell. That's not going to happen overnight.
Yeah.
You know, so, you know, I think you could just see some chopping around here for 2 to 3 weeks. And then as we get into July and into August is when I think the probability of a deeper pullback and an increase in selling pressure starts to really go up.
All right. Well, what does that mean for the dollar here? Because the dollar is still holding up. I mean, it's pulled back a little bit, as you can imagine, with risk, but it's not really doing a whole lot. Do you have any expectations here?
Well, 2 weeks on our call, I said, the RSI was up to 70. I think the dollar's going to pull back. So far, that pullback looks like an ABC, and if I'm right about what the Fed's going to express with their projections and the rhetoric that's going to come up, I think, the dollar has softened in part because people are buying into that, hey, the Fed may or may not increase rates anymore, and there's a little softening going on. The other thing I think is going to help the dollar is weakness in the euro. They did get 2 quarters in a row of negative growth, which, again, technically is a recession. Their unemployment rate is very, very low. So it's kind of similar to the U.S. last year. But I think Germany looks kind of weak. So I just think the relative performance of the economy in the U.S. relative to the Europe is going to be a support for the dollar. So I continue to think, as the technical pattern shows, A up, B down to the lows below 101. I think there's a rally that gets us back to the high of wave A, which was 105.88. And then we'll see what happens. And again, it comes down to people misreading how dovish the Fed is going to be. Remember, they've said we're going to get the funds rate up to a level, and then we're not cutting it for all of this year. I'm not sure that point has fully sunk in. As you said earlier, people still think that once weakness shows up, the Fed's going to cut. And the answer is no. With the unemployment rate under 4%, the Fed is not cutting rates.
Well, it's interesting. I was just talking to Mark Chandler of Bannockburn Forex yesterday, and and by the way, I'm in your camp. I'm a dollar bull trying to buy a pullback here, trying to get a euro short off a little higher than where we're at. But he believes that he's opposite. He's looking at interest rate differentials between Europe and the U.S. So that's what makes a market. It's different views, different viewpoints. And I think it's important to take them all in. All right, Jim, that is the dollar. The last chart. Well, no, you brought 2 more charts, but you brought in gold. Gold has been in this just tight range between the 1930, 1985, depending on what feeds you're looking at.
Yeah, $45-50. Yeah.
Yeah, really, really tight range. Do you think we break here next week?
I think there's a potential that gold will pop above 1983. In other words, you had 5 down. If you look at from the high of 2050, whatever it was, 59 or 57, I can't remember.
There, yeah.
You got 1, 2, 3, 4, 5. Okay, I think that suggests that's wave A. We had a bounce. I think this pullback, as long as we hold above 1938, there's the potential of a pop above 1983 to complete an ABC for what I think would be wave B. And then from whatever that high is, wave A was $121. So what price target, if it gets up to 2,000, just to make the math simple, $121 would get you down to about 1890. Oh, how about that? The 382 is 1890. So I think that if the gold pops above 1983, it's an opportunity to look to go short, because I think there's another leg down. Bigger picture, I think gold, after it completes this wave 2 correction, we're going to see it go to all-time highs.
Yeah. All right, Jim. And then I know you've been saying that you're looking for a move somewhere down here for a move to all-time highs. So that's the bigger picture for people to be taken in. All right. Last but not least, you did bring a chart in the bond market, and bonds have been, or the TLT has been kind of steady. And I sit there and I look at yields and think, man, why are they up here where they're at?
Yeah. Well, I think again, the idea that we're not going to have a recession, I think we saw about 4 weeks ago there were 2 rate cuts priced in. First cut was going to happen in July when we were in March, and then they pushed it back to August. And then a week ago it was like, well, maybe there won't be any cuts. So I think that's one of the reasons why yields have been holding where they are.
Yeah.
When the TLT dropped down to just about 100, you can see at the bottom panel, below the green line means it's oversold. My expectation was we were going to get a bounce to relieve that oversold condition. But I think if I'm right about the Fed kind of sounding hawkish, not just next Wednesday, but in the following weeks and given speeches and so forth, that TLT can have one more dip that gets down near the 98.86 or whatever low that was. And that's why I'm saying, hey, if it gets down below 99.20, be a buyer, because ultimately I think the economy is going to slow in the second half. Inflation is going to continue to come down, and I think that's going to be positive. Plus, there are a lot of shorts in the Treasury bond market.
Yeah, I've heard that too. That a lot of hedge funds are really laying into the short side of the bond market. So,
and part of it too is, okay, we got a huge wave of supply coming. The Treasury has to rebuild its general account balance from less than 50 billion. I think they're going to try to get it up to 400 billion or so by the end of June. Ultimately to 500-600 billion. That's a lot of paper. Most of that paper is going to be T-bills. And so I think we're going to see yields maybe tick up a little bit. But to the extent that people are, it's been a topic that's gotten a lot of attention in the last week. Oh my God, there's all this supply. Yields have to go up.
Yeah.
And I get it. It makes a lot of sense. But to the extent that at some point in time we see more data points showing the economy softening, that's going to spur demand. And what we don't know, Blake, is that increase in supply going to be funded from bank reserves, which would be a negative, definitely liquidity factor, or investors showing up? We don't know the answer to that. So my take is, I think it can put a little upside pressure on yields, which is another reason why TLT may dip a little bit. I just think that potentially it's being overblown. Now, is it a drain on liquidity? Yes, because what we saw from January when the debt ceiling was reached, the Treasury dropped the general account dropped by $400 to $500 billion. So they weren't selling any bonds, and yet they were injecting liquidity. Well, that's positive. What we're going to see is, no more injection and just the opposite. So I think net, it's a negative. And it's one of the reasons that is secondarily why I think the S&P is vulnerable to a pullback between now and early August.
All right. Well, Jim, I want to say, having you here every week, keeping our thoughts and our ideas straight and how we should be viewing the market. I appreciate it. I know if you're in the Trader Summit community, you're listening in, make sure you jump down below, jump in the comments and tell Jim, maybe there's some things that he didn't think about. Maybe there's some things that you might want to chat with him about. Make sure you jump in the comments section and get to him there. Jim, but how do we follow your work all the time?
Macrotides.com. And if you want a recent report, jimwelshmacro@gmail.com. And thanks, Blake. I love doing this. It's really fun to try to, if you will, discuss and explain economic stuff and then be able to talk technicals and at times be able to integrate them. And this is one of those times. So I love doing this, and I appreciate, us being able to do it every Friday.
Absolutely. And we love it, Jim. So I want to say good luck next week for the FOMC. I can't wait till next Friday. We get to break down all these central bank meetings from the Bank of Canada or Federal Reserve, European Central Bank, and the Bank of Japan. Woo! And
a trifecta.
It is a trifecta. Have a great weekend, Jim, and thanks for being here every week.
Always appreciate it. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.